Welcome to the deep dive. Today we're digging into Gravita India Ltd. We've got a stack of documents here, company filings, auditor reports, their investor presentation, basically everything around their Q1 FY26 results. That's the quarter ending June 30, 2025. So our mission for you is to unpack all this. We want to cut through the corporate jargon and pull out what really matters about this global recycling powerhouse. You'll get a sense not just of the numbers, but the Gravita's whole journey, their big plans, and importantly, how they're set up to really capitalize on these huge shifts happening in recycling. Think of this as your shortcut, really.
Yeah, absolutely. And maybe the best place to start is, well, the beginning. Gravita India Ltd. was founded back in 1992. First-generation entrepreneur Rajat Agrawal started it in Jaipur, India. A real ground-up story.
Right, and their whole identity seems built around this idea, building a green world through recycling. It really comes across strongly. They're into several main areas now, aren't they?
Yeah.
Lead, aluminum, plastic, rubber, and they even offer turnkey solutions.
That's right. And their vision, well, it's pretty bold. They're aiming to be the most valuable company in the recycling space globally. Not just valuable, but they've put a date on it, aiming for the top 5 global recycling companies by 2028. That's quite a target. And it's all driven by diversification, sustainable growth, pushing eco-friendly innovation, creating value for stakeholders, and all anchored really firmly in their ESG goals.
And you see that in their core values, too. They list fairness, trust, respect, passion, and nurturing relationships. They talk about an unwavering commitment to sustainability-driven values. It feels, well, quite central to them. So we have this picture of their identity, their ambition. But maybe we should trace their journey a bit, because how they got here is pretty revealing. It kicks off in 1995, establishing that first lead recycling plant in Jaipur.
Yeah, lead was the foundation, but what's interesting is how quickly they looked outward. By 2000, they'd already set up their first overseas unit in Sri Lanka, I believe.
Sri Lanka, yes. Shows that global thinking early on.
Definitely. And then Ghana followed in 2006, another overseas unit.
Then a big step in 2013, listing on both the NSE and BSE. That brings a whole new level of visibility and structure.
Right. And then the period from 2015 to 2019, that looked like a real diversification push. They didn't just stick to lead or geography. They added plastic recycling in 2015, aluminum in 2016, and crucially started focusing on value-added products both back in Jaipur and then expanding that into Africa in 2016 and 2019. That's moving up the value chain.
Exactly. Then 2021 seems like a packed year. New facility at Mundraport, adding rubber recycling to the mix, becoming an MCX and paneled brand.
They weren't slowing down.
Not at all. 2022 saw more aluminum and plastic expansion in Africa, and 2023 rubber recycling initiated in Europe. It's just constant motion, constant expansion.
I think if you look at the pattern, the key theme is that consistent, proactive expansion and diversification. They weren't just growing, they were building capabilities, anticipating where the market was going. It really sets the context for their current performance. Which brings us nicely to the Q1 FY26 financials. The CEO, Yogesh Malhotra, called it a strong start to the fiscal year. And, well, the numbers seem to back that up quite strongly.
Oh, absolutely. When you look at the year-over-year growth for Q1 26, so compared to the same quarter last year, volumes are up 12%. Revenue grew 15%. EBITDA saw a really healthy 22% increase. And profit after tax, Pat, that jumped an impressive 39%.
Wow, 39% on the bottom line.
Yeah. And even with that growth, their return on invested capital, ROIC, stayed strong at 28%.
Yeah.
Plus, value-added products contributed 47% more, and they sourced more scrap domestically, too. It's all pointing in the right direction.
That 39% PPT growth on 15% revenue growth, that really shows operational leverage kicking in, doesn't it? They're getting more profitable as they scale, which in a commodity-linked business is quite an achievement. You need discipline for that. Let's put some concrete numbers on that. Consolidated revenue from operations for the quarter was ours, 1,039.94 crores.
So over 1,000 crores.
Right, up from about 908 crores last year. And that profit, the consolidated profit attributable to the owners, hit ours 93.26 crores. Last year, it was 67.33 crores.
Big jump.
And that translates to a basic earnings per share EPS of ours 12.81. Last year, it was ours 9.82. So significant growth across the board.
And just quickly, the volume breakdown for Q1, lead was the biggest chunk, about 46,215 metric tons. Aluminum was nearly 5,000 MT, and plastic around 2,400 MT.
Okay, so solid numbers. But these results aren't just happening by chance. They feed into and come from their longer-term strategy. They call it Vision 2029. It's their roadmap for the next few years.
And it looks seriously ambitious. They're talking about capacity expansion, aiming for over 700,000 metric tons per annum by FY 2028. That's more than double their FY25 capacity of around 333,000 MT.
A huge leap.
Yeah, and they're planning the spending to back it up over FY1,500 crores in capex by FY 2028. That's for existing stuff and these new verticals they're pushing into.
And those new verticals are key, I think. They're specifically targeting scaling up lithium-ion battery recycling, paper recycling, and steel recycling. That's moving beyond their traditional base into, well, potentially massive future markets, especially lithium-ion.
And the financial targets under this Vision 2029, they're aiming for 25% plus CAGR on volume, but even higher on profitability, 35% plus growth there. And they want to keep that ROIC above 25%. That's demanding.
It is, and it involves a strategic shift in their mix, too. They want value-added products to be over 50% of their business, and they want the non-lead part of the business, aluminum, plastic, rubber, and these new ones to grow to over 30%, so less reliance on lead over time.
Right, diversification in action. And they seem quite disciplined about how they spend that capex. New projects need to hit that 25% plus ROIC target with a maximum payback of 3 years and turning assets over 8 times. Pretty strict criteria.
Which points to their operational strengths. These aren't just plans on paper. They feel confident they can execute because of their existing capabilities. That allows them to look at these new, maybe more complex recycling areas.
And their operational footprint is just vast, isn't it? You mentioned global and pan-India.
Yeah.
It's 12 recycling plants, 33 of their own yards worldwide. And this figure is amazing. Over 1,900 touch points for collecting scrap. Globally, that lets them gather over 287,000 metric tons of scrap a year. The logistics must be incredible.
It must be. And that presence across Asia, Africa, America, Europe, it's not just about volume, it's about getting raw materials at competitive prices. That's a huge edge.
And then they turn that scrap into over 203,000 MT of recycled products, selling to over 340 customers in more than 34 countries. It's a truly global loop.
So how do they protect this position? They talk about industry-specific entry barriers. Things like needing specific import licenses, having the specialist know-how built up over years, getting approvals from OEMs, plus the networks they've already built for sourcing and selling. It's tough for a newcomer to just jump in.
Yeah, that makes sense. And they also have that turnkey solutions arm. They're not just doing it themselves, they're selling their tech and expertise. In-house technology, consultancy, control systems, maintenance contracts. They've done over 70 projects globally, places like Qatar, UAE, Poland, Chile. It shows real depth in their technical skills.
And one really crucial operational or maybe financial operational point is their hedging, the back-to-back hedging mechanism. Essentially, when they lock in a sale price for recycled metal, they simultaneously lock in the purchase price for the equivalent amount of scrap.
So they're protected from price swings.
Exactly. It takes the volatility of commodity prices largely out of the equation for their margins. They started this for metal scrap back in June 2016, and then in June 2019, they expanded it to hedge their core inventory too. It's about ensuring stable, predictable profitability. It's smart.
And all this ties back to their competitive edge, especially with customized and value-added products. Things like specific lead alloys or different plastic granules, even food-grade PT flakes. These aren't just basic commodities. These contributed, 47% in Q1? That shows customers want these specific products, and it gives Gravita better margins and, makes them stickier suppliers.
Definitely. Now, shifting gears slightly, there's a major trend in India that's really important here, this paradigm shift towards formalization in the recycling sector. It's moving away from the sort of informal, unorganized players towards companies like Gravita.
Right. And this isn't just happening organically. There are big regulatory drivers. You've got the vehicle scrappage policy pushing old cars off the road. You've got extended producer responsibility, EPR, making manufacturers deal with end-of-life products, plus specific rules like the battery waste management rules, BWMR. And stricter GST implementation kind of helps formal players, too.
And the impact for a company like Gravita is potentially huge. It means more domestic scrap becomes available through formal channels. They can utilize their plant capacity better. Logistics become smoother. They can form direct tie-ups with OEMs. It even helps their working capital. It just makes the whole ecosystem more efficient for them.
And given Gravita's pan-India network and their existing OEM relationships, they seem perfectly placed to benefit. Especially when you see projections that the informal lead recycling sector could shrink from like 80% of the market in FY16 down to maybe 25% by FY26. That's a massive shift towards players like them.
It really is. And underpinning all their operations is this sustainable circular business model they talk about. It's a loop, finding scrap at the last mile, sorting and checking it, processing it cleanly, creating value-added products, checking quality again, delivering, and then feeding customer satisfaction and R&D back into improving the whole process. A true circular approach.
So maybe we can round things off by looking at their ESG commitment. They frame it as towards clean, green, and sustainable future. It seems pretty central. On the environment side, they're reporting 14% green energy use, biofuels, and renewables. And around 28% of their total energy is from alternative fuels.
And that renewable generation figure is striking up 59% year over year. They generated about 8.5 lakh units in Q1 FY26 alone. Plus, they've got a new solar project in Senegal, pilot projects using CNG and oxygen, and their plants have that ISO 14001 certification for environmental management. It's a tangible stuff.
Then on the social side, over 3,000 employees, average age 36, average time with the company 5 years. About 7.8% women employees. Importantly, 0 fatalities reported in Q1 and 100% health insurance coverage. They've launched a talent development program, Gravita Ignite, spent about 2.75 crores on CSR, and they have the ISO 45001 certification for health and safety. Seems like a strong focus on their people.
Yeah, it does. And finally, governance. Half their board are independent directors. They have a dedicated ESG committee at the board level, no ethical breaches reported. Good credit ratings, AA from ICRA and India Ratings. They're MCX M-paneled, ILA registered. And they've done 4 rounds of employee stock options, ESOPs, which helps align everyone's interests.
And what makes this ESG push convincing, I think, is that it's not just ad hoc. They have a proper roadmap. Short-term goals for FY27, mid-term for FY34, and long-term aims out to FY50. Like net zero emissions by FY50 and zero waste to landfill for the whole group by 2050. That's commitment. So yeah, quite a picture we built up of Gravita India. Solid Q1 performance, yes, but also this really ambitious growth plan and what seems like a genuine commitment to sustainability.
Absolutely. And understanding a company like this, it goes beyond just the financials, doesn't it? It's about seeing those big industry shifts, the environmental angle, and the vision driving it all towards that circular economy idea.
So maybe a final thought for you to consider. Given Gravita's big push into new areas like lithium-ion recycling and their clear ESG focus, how might a company like this actually shape the future of resource recovery globally? Not just metals, but maybe other things too. What other waste streams could become really valuable down the line? And how fast can companies like Gravita pivot to grab those opportunities? Lots to think about there. Thanks for joining us on this deep dive.